folks, I'm L.A. Little and this is your daily TA wrap. Well, let's take that back, the weekly TA wrap. Well, we take a look at these markets on a weekly basis. And we do it while focused on the two tenets of neoclassical thought, and that is, what is the trend and where does the supply and demand show up on the chart? I do the show once a week, every Sunday night, live at 9 o'clock Eastern Time here from the base of the snowy Rocky Mountains. Folks, it's it's holiday season, not many folks are around, everybody's off doing their thing, preparing for the new year, making their New Year resolutions, looking at what they've done good, bad, so forth, right? That's that time of the year you reflect, you look forward, you set your goals. So, what's our goals? Our goals always make money and to use these markets to make a consistent profit over time. It's not always as easy as said as done. It's not a simple thing. The concepts are simple, but to put it in practice is always a little bit difficult. And that's because the market moves around a lot. And talking about moving around a lot, let's take a look at how these markets look here. I'm going to start with the S&P 500, and the reason, of course, is that the S&P. We'll do it from here. The S&P gives us a broad swath of the biggest companies in the country. There's 500 of them. They're all situated in here. I want to look at the weekly charts as well. One of the things you always have to look at, and when I look at this weekly chart, is you have to look and see where your risk is on the downside, right? And with the TA Today charts, they're drawing in risk for you. They take a look at anchored support, which is another name for demand, right? Where the demand should show up, and if I look at it, I can see the support. These blue bars tell me where it comes in, 1687. Right? We're trading at 1841. So in other words, on a weekly basis, what does this tell you when you see this? It says on a weekly basis, we could trade back to, in the high here, 1703. We could trade back to 1703 to 1709, somewhere in that area. And that would be a perfectly normal retrace. And that's where we should see the buyers show up. That's really what that's telling you. So if we could trade back to 1709 and we're trading at 1841, that's 130 points to the downside. 130, 140 points to the downside. That would be roughly, 8% or something. It's maybe 7%. So you could get a 7% retrace, and it would be quite normal. And matter of fact, you would probably want to buy it. That's what you're looking at when you're looking at the intermediate term time frame and you're trying to ask yourself, okay, where is a good place, to buy something on this time frame? Well, it's quite a ways away, 7% to the downside. And part of that is because we just keep going up, right? Last week was another week up, and nothing like the week prior in terms of a stretch, but it stretched higher, another 1.5% or so. If I look at this, the next thing you want to look at, and the reason I'm going over this is, a lot of people lose track of risk, and risk is always the most important thing you should be thinking about. And so if we look at this, the next point of not resistance, but risk is, where's your swing points line up? And in this case, if you count forward 6 bars, you got 1, 2, 3, 4, 5, 6. The low on that bar, 1777.23, and do we have a lower one? Yes, we do. So if we have a lower price point, 1777.23, and we do here, that means that we have to go 6 bars from the lowest one before we can put in another swing point low. And since we traded down deep a week ago on the Fed news, the setup here is that you have to come all the way back here to break this trend. Now, what does that mean? Well, trend can only transition when a swing point low is broken. And so to break a swing point low, we would have to trade all the way back down to that low, which is 1646. And we're trading at 1841, roughly, almost 1846, so almost 200 points lower. 200 points lower would be about 11%, 12% correction just to get back and even try to transition on this time frame to just sideways from bullish. That's the kind of extension we have. So when you see that kind of extension, you realize that, we're really kind of stretched. I mean, one could use Bollinger Bands, one could use moving average, one could use a lot of things to try to understand stretched. I like to do it based on supply and demand. Where do I expect the buyers to show up? Where do I expect the sellers to show up? Now, when you don't have any kind of resistance zones, you don't know where the sellers are going to show up other than on shorter term time frames or on projections. And in this case, we have projections, and those projections have almost been met. What were those projections? Well, if we walk over here to the daily, right, we had a range trade breakout. In other words, we broke out over this range and we traded up, or are trading up to the top side of a duplicate of that range in terms of how far this is, right, versus how far that is. So you just do an equidistance. That's the way these are set up. And you look at them and say, okay, well, it should come to about right there. Where is about right there? Well, on the S&P, it's about 1850, 1849, 1850. We traded to 1844. So almost 1845. So we were within 4 points, 5 points of that projection. Now, once again, where's the swing points here? Well, in this case, you've got not swing points, but the anchored support zones. And in this case, you've got an anchored support zone. It's kind of hard to see, but it's sitting right here, and I'll draw it in black. It's sitting right here at these swing point highs. Okay, why was one of the reasons we got bullish, and swung into action here to catch this move was because that move was based on a breakout of two swing point highs. That gets you usually 2 to 3 bars in the direction of the trend, which is exactly what you saw happen here as it stretched to higher. Now what is it doing? Well, on the daily it actually went over and under on Friday, but the volume was slightly heavier, so it's not really a 2-bar reversal, but you certainly have had a nice big strong move up. It would not be surprising to see this thing come back and do a retest in an attempt to regenerate off of those prior swing point highs. And that retest regenerate would look something like this. You would take the highs that are broke over and you'd say, oh, well, this thing can trade back into this area. Now, if it comes back hard and fast, it will come back within 6 bars. If it does that, the odds are not nearly as good to buy it. But if it comes back after that, which looks like a decent probability, not necessarily going to happen, but right now you've only got 2 more bars you need. If you stay above these swing point highs for 2 more bars, then you'll have 6 up here. 6 bars gets you a fairly high probability. And when I say fairly high, I'm talking about 90% range. That's a pretty good probability. When this thing comes back, if it comes back after 6 bars over here, then that gets you a fairly high probability. You can kind of just blindly buy the thing. So when you're looking at it from that perspective, can this thing pull back? Yeah, should it? Probably. If it does, what do? Well, you kind of think about buying it, especially if it's after 6 bars, all the time realizing that just simply says you should get at least a bounce. Okay, that doesn't mean new highs, new leg up, anything. It just says a bounce. That bounce could set up an ABCD structure to the downside to get you lower. It could set up another ABCD to the upside. That's always the case. It always works this way. So in other words, right now you've got this A structure going up. You don't have a B point yet. If you get one, right? And you pull back to here and you get the bounce. If it breaks over this area, you get a ABCD structure to the north, right? A bullish one. If it doesn't, then you potentially set up an ABCD structure on the downside. In other words, this comes down, tries to go back up, can't, and then you get an ABCD down. Anytime you get the retrace going, that is the two options that are available. And then you pick the highest probability one using the sort of thing I just talked about with the retest, regenerate, and the probabilities associated with it depending on how fast it comes back and how it comes back. So, I just thought it was important. There's not a lot to be said about these markets right now other than they continue to melt up into the end of the year. We expected that would happen. Once we saw the reversal off the Fed news, we knew there was a high probability of that. Hopefully you took advantage of it. I know as we did, we tried to take advantage of that and run with this thing to the north side. There's none of the indexes telling us that we're going to get a breakdown. The only one that gave us any kind of clue was the Dow Jones. And the Dow Jones actually did an over-under and did it on less volume. And what is that? That's a 2-bar reversal. A 2-bar reversal happens when you go over the prior day's high, close underneath it, volume's lower, and you have an extended move. And that is the setup here. So this is a 2-bar reversal. This says that the Dow should trade sideways to down on the very next bar. And we'll see how that plays out tomorrow. We've only got 2 days left in the year. A lot of times it's window dressing this type of time of the year. You may see some profit taking, but most people are probably going to want to try to squeeze those profits into January, which itself is kind of a dangerous setup. In other words, you wake up on the 1st of January and everybody's selling because they wanted to avoid taxes this year. We'll see if it trades that way. I've seen it happen that way, especially when you've had a big year up and then you have a stretch into the end of the year. So that's one of the risks of just hanging out there. 2-bar reversal on the Dow, it's the only one showing us that. If I look at the sectors, there's really nothing bad in the way the sectors are trading. If I look at them from, I'm trying to pull them up here, let me see, major sectors. If I pull these guys up, and just flip through any of them, and I'll take some of the weakest ones. Here's the IYT. Amazon blew these guys away with UPS, couldn't deliver all the packages. But they're still at highs. They just broke over highs, right? These are stretches, and this is like probably one of the weakest ones. Of course, the two weakest ones really are utilities and consumer staples, but they're kind of in a world of their own because of interest rates, which is really where we should go next. So let me pop over and we'll pull up the interest rate structure and take a look at that. All right, so let me grab the TLT is the first one. And if I look at the TLT, here we go with breakdowns, right? Now TLT is the 20-year bond. This is the long end of the curve. And on this long end of the curve, you had a swing point here, you had a swing point there, and now this price point has broken under them. That's a breakdown on 2 swing points on this time frame. That in and of itself can lead to a faster move to the downside. 2 to 3 bars extension to the downside. But you also have on Friday a break of this swing point low right here. Underneath it, you can see the trend transition here telling you that, right? This one also is a break. So now you have it on multiple swing point time frames, right? On multiples. On the weekly, on the daily, on the long-term bonds. And what does that say? That says that interest rates are inverse going the other way. The long bonds really don't control most of the interest rates you and I see. They're just a good indicator of that part of the curve that the Fed doesn't have as much control of. But if you pull in the 7 to 10-year bond is where the effect is on like housing. Any kind of loans are typically tied, especially housing, to the shorter ends of the curve, and this is the 7 to 10. This one has a direct correlation with housing, and you can see here it hasn't broke the swing point low, but it certainly looked like it's going to try to test it. Right, volume's picking up as it's coming down to it. That's going to be a big number when it gets there. We'll see if it wants to break or if it holds, but you've already got breakdowns here, right? And this thing is just pushing lower and pushing lower each day. Another swing point break here, which was a, if you were able to see, there was a swing point low over here, so you just got another one on this break on this time frame. And if you go to the shorter end of the curve, you know, so like the 3 to 7 year bonds, it's the same picture. And this is where the Fed has the most control. And even here it's having difficulty keeping interest rates near zero, which is what they've been trying to do. So on all of these, if this draws, on all of these we're seeing an extension down. This is the 3 to 7 year. We're seeing an extension down, and that extension taking us to lower and lower rates, bond prices, which is increasing the rates. The 7 to 10 year went over 3%. It hasn't done that since about September. If it continues down, it will have an effect on the equities. Let me take a few questions here, and then I'll go back to other things because I've covered the main points. So you bought some CCE. Can you check it on the weekly chart? Sure, let's take a look at it. CCE is Coca-Cola. They had a, we were just talking about on the bonds here, a breakdown on the on 2 time frames, getting multiple swing points, broken. Well, CCE is the opposite. It went the other way. So this one broke out to the top side on multiple swing points, which just, if you just take and turn that thing upside down, what that means is that you've got, not CEE, but CCE. Let's try that again. That says that you've got the opposite effect where this is going to try to pop up and make new highs, right, and extend to the north. And so if we look at this one on the weekly, so you can see here a swing point high. You got the break last week. It's over the swing point high. And then you had multiple swing points here to break on the way up, right? And you can see the extension, 1, 2, 3 bars here. Now, when you're doing these extensions and you get it on multiple time frames, that says you should see 2 to 3 bars here as it pulls away. So CCE, it's a little stretched. Can it come back, mill around and everything? Yeah, sure. This thing can set up some sort of an ABCD structure like this to get higher. You would expect, given this, there's a higher probability that this thing just keeps going. And that's the way it's set up. And right now, that's exactly what it's doing. I would be watching this bar. Even though the volume doesn't matter as much, it did break over it with lighter volume, so you could get a quick retest regen off of that. That high is 42.95, and 42.95 would actually get you back into a retest regen over here as well. So we'll see, and that's probably this bar actually. Yeah, it is 42.95. So we'll see if it wants to come back. But no, it's stretched. It's made a big move. Can it keep going? Yeah. With the break on multiple swing points, it definitely can. So yeah, it's a good looking stock. JPM. You like JPM, don't you? Let's see what JPM looks like. So JPM, one of the big bank stocks, they actually have been struggling to get higher. They took in, all these bank stocks, I keep watching them, and they keep one after another paying fines. At JPM, for whatever reason, they're always in the news in terms of fines. Seems like they settle some sort of a claim every week anymore. I don't know what the last one was, but it's tied to mortgage debacle. It's tied to all kinds of problems. So let's see what JPM looks like on the weekly. Boy, I need to restart my computer. It's really slow tonight. Come on, baby. Here we go. So it's at the highs. So you got the break 4 weeks ago. And it's still hanging there. Alright, so that's got 186. You get over it with 139. You're hanging there, retesting and regenning. And that's a positive. And you also got over it here prior, and you've retested and regenerated higher here as well. Although you did 1.1 on the Fed day versus the 704 as you tested the breakout bar, which was 1.023. Well, this looks to me like it's going to hang here longer. I know that's probably not what you want to hear, but you know, I think you're in. I think you're going to stay in a range trade here for a little bit longer. You know, this area. I don't know that it's going to make it back down here and test it, but it certainly can. Right, this swing point low it made. It could certainly get a test on that bar. That's the Fed bar right there. It doesn't look bad at all. It just looks like it's not quite ready to jump out of here. So it's in this little range, right? The range above it would be about there. You know, nothing terrible, but at the same time, I think it's gonna have a hard time lifting still. Looks like it's gonna range trade a little bit longer. All right, so you know, one of the things that is hard when you're trading is to kind of block out all your biases and try to look at the market from a unbiased point of view. And that's hard to do when you have positions on, you know, because you're kind of rooting for your positions, you're wanting them to go up, whatever. And it's hard to step back and see the other side, you know, of what could happen. And so, you know, we can take this JPM Morgan as a good example. And let's look at it from the other side. So, you know, Feedy's interested in this thing going higher, of course. Well, where's the risk structure, right? If I look at the risk structure, where is it? Well, it's obviously here. You know how we talk about swing point highs, multiples breaking? What if you break multiple swing point lows? That can lead to 2 or 3 bars fast move on the way down. So if this thing did come back down here and did test this area, right, you could get a fast move down on that break. There's even more danger if you come over here and look at this at lower lows, right? If you were to break this area, and if you start doing the calculations, I mean, this is that low was 55.40. 55.40, I could see this thing trade down another 2 or 3% pretty easy, right? That would take you down to, you know, 54, 53, take you into this bar. Top of that bar is 54. Okay, so if I go over here, what's the low that this is? That's 53.15. That's not that far away, right? That's another 0.75%. And then these are certainly lower. The lower ones here, 50, right in the 50 area. So you could see this certainly trade back into this bar and potentially to the bottom of it, 51.80, which would get you into the swing point low, 51.58. That is the risk structure. So when you're trading something like this, depending on where you got in or if you want to get in, you certainly, you know, now, you know, if we think about it from a different point of view, if I, you know, given what I just said in terms of the, you know, it looks to me like this thing's going to range trade a little bit longer. If you do buy the bottom end of that range, you have to set those stops pretty tight. I mean, it's not critical that they be immediately there, but you don't want to let it get away from you on the downside because you could get 2, 3, 4%. Now, if you're trading it on this time frame, That's probably unacceptable. If you're trading over here, it's a little different story, right? You trade back into the bottom of this. You got a support zone right in here. You can see it in green, right? You would want your stops deeper, but you would have to protect against these swing point lows breaking. So no matter which side of the trade you're on, always look at the other side and say, what's my risk structure? The first thing you should always ask yourself is, what's the risk? Is the risk, greater at this particular point in time or not? That depends on the stock. That depends on the stock sector, right? You want to look at the XLF, but they're all strong. And it would depend on the SPX itself, which this trades in, which itself is strong. So certainly the bias is to the north. That's why everything keeps working to the north. But at some point, these things will set up to where they're more dangerous, and you can actually see where the danger zones are simply by looking for the swing point lows. Because why? That's where trend will change on you, and you'll get fast moves. And the moves on the downside are a lot faster, right? When you go this way, it's a lot faster than when you go that way, right? The downside's always fast and furious and, debilitating. And the upside is just, crawl, crawl, crawl kind of stuff. Every now and then you get a spike. But it's a different trade, and so you always got to look at the risk side of it, not just the reward. All right, folks, I'm about out of time. We got 2 days left. If you look at the economics, you got PMIs, flash PMIs that will come out on Thursday. You got the unemployment. Then you got the Fed next week. After that, you got a bunch of Fed speakers on Friday. This Friday, next week, the Fed, not the minutes, but the Fed meeting, and then earnings season, right? Kicks in right after that. So you can see that there's a lot about to hit, and of course it's the new year. Most fund managers almost always want to be fully invested to start the new year, because if they're not, and if the market jumps, they're starting from behind and it's hard to catch up. So they come into the new year. If the market drops, hey, they don't get paid to make money. They get paid to make as much as the S&P, or to lose less than the S&P. That's really what they're measured on. So if they're not invested fully to start the year, they can lose to start the year. But if they're invested fully and the market goes down, hey, they didn't lose anything in their minds, because they're still even with the market. So expect them to be fully invested. Expect a lot of news to hit to start the new year, and that's after big runs. Looks like a powerful combination for some sort of a retrace in here somewhere pretty darn soon. Have a great night. Take care of yourself, and until next time, this is and was the Daily TA Wrap, or actually the weekly one. See you next time. Good night, folks.